at hand
The business,
first or after?
well, the business at hand is I will teach later, if that's okay with that. I thank you for your approval of that idea, but I'm happy to teach later rather than doing every other week on a Sunday, which I think may be a reasonable idea, particularly since we are the last class. There's no constraint after me other than understandably getting home to your families, which I know I am keeping you from that.
Wait, no phone calls, or yes phone calls? No.
Excuse me?
No phone calls.
No phone calls.
Okay.
So we'll get rid of that, and we'll just go to longer lectures until I reach. So today, for example, today I maybe, if you don't mind, and if you do, we'll make it up next time. But I will be here till at least 4:30 and possibly slightly later. It's my fault, but I do want to, if I can, get a certain amount of material in, and we'll play it by ear. Once at 4:30, we'll all be tired, particularly you guys. I feel like I've had, I'm going to be exhausted because I've been stressed out for about 2 hours trying to figure out how to get back into Manhattan. Anyway, I thank you for your understanding. I mean it.
But the basic structure is going to be 4:30 on the weeks that we're on.
That's it. Yeah, why not? We should. Perhaps I could consider that initially, since there's no class after me, so it makes sense to get it done. Good. That's good news.
I'm very happy with that.
All right, I want to sort of get back to our discussion on Sunday and ultimately, hopefully make it clear how this type of, so it's like a budgeting system. It's a budgeting system dealing with companies that are manufacturing. And the way it works is they put into the accounting system a budgeted amount of overhead as the period goes on, and then the end of the period they somehow reconcile. So I want to, it's not in the book, there's no journal entries in the book, but I thought for once, since you guys are a little bit familiar, very familiar with journal entries, I should at least give you a sense of what's going on in the real world, the way this type of system works. And hopefully, last semester, we're all hopefully remembering the way inventory worked. The way inventory worked is the firm was not a manufacturer, and they typically bought finished goods already. And what was the journal entry? Let's go back to a little journal entry stuff. Last semester, so a firm bought inventory to sell, and it was already done, finished. They weren't manufacturing it. So what was our journal entry? We did, well, assuming they did it, they usually purchase these things on account. So for example, let's assume that, let's think of a good J&R, whatever, is buying cameras, etc. on account. So they receive the merchandise, credit accounts payable, debit inventory. So that's what we had. We had debit inventory and credit accounts payable. And this was for the merchandising retail type company. It was fairly straightforward. You didn't have to keep track of your costs. The only cost you kept track of was on the invoice for the finished good that you were buying. So life was easy, relatively. Credit accounts payable, debit inventory. That was pretty much. And then when they used it up, they, of course, credit inventory, debit cost of goods sold. That was last semester, okay? This semester is a whole different ballgame. And again, your book doesn't use journal entries, but I thought it might be in this case helpful. So there are really, in a manufacturing company, there are three types of inventory. There's raw materials inventory, there's work in process inventory, and then there's finished goods inventory. So you have raw materials inventories, you have work in process, and I'll tell you what that is in a second. And finally, you have finished goods inventory.
The marker is really strong today.
What?
Is it new? The marker?
It's taken from my bag. I was determined to get clean, workable things. All right, so I know we're not used to that. We're used to like struggling to see what I'm writing. So 3 different inventories for a manufacturing company, okay? And so their goal, for many reasons, including financial statements purposes, they have to do this, and also for keeping track of the cost of their goods, because you have to know if you're making money or not. So it's useful to know how much your goods cost. So to keep track of their goods, they're going to basically be going in and out of these 3 different accounts throughout the period. Now, work in process is the name of the account we give to unfinished goods by the end of the period. So again, visualize the factory floor. You're looking at, say, a furniture manufacturer, because we're looking at job order costing, meaning very discrete type of units. They're very discrete, different, sometimes even different types of units. So you look at the factory floor, and you see work in process, you see these unfinished dining room set, and the period is over, and that's part of work in process. And the name, I think, is pretty explanatory, self-explanatory, work in process. So, with that in mind, so they purchase work in process, they purchase inventory for raw materials. The work in process consists of also not just raw materials, but also labor, right? Direct labor. And so direct labor and direct materials are funneled into work in process through journal entries during the period. Such as, let's look at raw materials, for example. Let's say a job uses raw materials. Let's call it job A. Uses raw materials. So you would have, basically you'd have work in process and raw materials. So you would credit raw materials and debit work in process for the raw materials that are now being given to the factory for the use of this thing, right?
But they don't equal the same amount, do they?
They're both assets, right?
Yes. These are all three different inventory accounts. 1, 2, and 3. 3 different separate inventory accounts. So when labor comes in, direct labor you'll have something like salaries payable, and you'll have work in process. So notice direct materials goes into work in process. Salaries payable, which we last period would debit salaries expense, now we're debiting work in process. These are inputs for inventory that have not yet been sold. Hence, they're all being shuffled into the work in process. So direct materials, direct labor, this is what you would typically see, okay, for jobs. The hardest thing is, these are traceable to the actual jobs. You can, as we showed you throughout this chapter, they keep very careful track of the raw materials and the direct material, direct labor that goes into each job through these different ways. What is more tricky, though, is not the direct costs, it's the indirect costs, the costs that you can't readily trace to these units, to the inventory. That's always a challenge in management accounting, cost accounting. How do we allocate these indirect costs to the products? And one way, which is what this chapter is showing us, is they use a budgetary type system where they estimate a predetermined rate before the period. And they, depending on how much, usually the rate is based on something like labor hours or could be machine hours, things like that. Depending on how many labor or machine hours that are used in each job, they get allocated a certain amount of overhead. So basically, the company has to keep track of the allocated, the so-called estimated budgeted overhead that goes into work in process. So the way they do it is, they keep 2 accounts going. And I don't want to get into too much detail, but hopefully this will make it a little easier to understand. One account is called the applied overhead. The other account is called actual overhead, which is the actual amount they spend. The overhead being things like indirect materials, depreciation, anything that's an indirect cost goes into this account. So for example, in what we've been doing, you would have something like, let's say, overhead applied would be an account. So we credit that, and you would debit work in process for the estimated overhead that it's getting basically allocated to the products during the period. The actual overhead is you credit things like depreciation, accumulated depreciation, and you debit actual overhead. So you basically have the following. You have overhead applied. Again, credit this account, debit work in process. That's how this account is created. You have actual overhead. And here you would credit cash, credit accumulated depreciation, and that would be going on like this. So the actual overhead is debiting this, is basically as you credit these, accumulated depreciation, you credit cash, whatever costs you're actually incurring for overhead, you credit that and you debit actual overhead. whatever you're estimating, you credit the overhead and you debit work in process. So basically, you're keeping track of these two things, and so at the end of the period, you have to reconcile these two things. You have to reconcile. Because the only thing that should end up in your final financial statements is this. So let's say, for argument's sake,
So that, in the overhead, you're including like, even, like all the things that are sunk costs also?
well, it's
For, like,
depreciation.
the depreciation and
Yes.
all that.
Anything that's a manufacturing cost, it could be depreciation of the factory building, it could be depreciation on the machinery, it could be the salaries, it could be the salaries of the
Management.
of the managers who go from station to station, seeing how everything, the supervisors, because that's not considered a direct labor cost, that's an indirect labor cost. So anything that satisfies our definition of manufacturing at the one hand, but is not direct materials or direct labor.
Okay, but not like the marketing costs?
No,
and
no,
not-
this is only manufacturing cost, product cost.
Direct and indirect.
Yes, so the direct is this.
Direct is only labor and the.
Right.
Yeah.
Everything else, the estimate goes into work in process. The actual, you credit the cash, you credit accumulated depreciation, whatever indirect manufacturing costs, you credit those and you debit the actual overhead. So at the end, you've got this debit amount and actual overhead. You've got this credit amount overhead applied, and you have to reconcile. So let's say, I'm going to give you some numbers and let's see what happens, okay? Supposing actual overhead let's say at the end of the period, we have actual overhead of $1,000. And let's say we have overhead applied of $900. Okay? Keep it simple. So we're at the end of the period. Now these are, by the way, and I believe I talked about that last semester, these are temporary accounts. Remember that term? Temporary accounts versus permanent accounts? Temporary accounts are those accounts that are really kept for convenience, like placeholders during the period. They keep track of sales and expenses, dividends, anything that you wouldn't find on the final balance sheet.
But you end up zeroing.
You do, exactly. So these are other examples of temporary accounts. These will be zeroed out at the end of each period so that the next period starts at zero. So what we're going to do is we have to close out these two accounts. And so what you would do is this. How do you close out a credit balance? How do you zero out this balance at the end? Because it's going to be wiped clean for the next period so that the next period is going to begin at zero. So this is a credit balance. How do you wipe it out? You have to, yes. So you're going to closing entry is going to be overhead applied. We're going to put it for 900. So that's going to be 900, and this is going to zero out this account. What are we going to do to this? We're going to, I'm sorry. How do we get rid of a $1,000 debit balance? We have to credit it. And that's going to zero out. So we're going to credit actual overhead. And this will be, okay, this is what we called last time the over and under applied situation, okay? So in this case, do we have an over and under applied situation where we have the applied is 900 and the actual is 1,000? Do we have an over or under applied?
Under.
Under. Because
Actual is over what you.
that's correct. We have an under applied. We put too few overhead costs into the actual product. Now there are a number of ways to handle this last part of the entry. Notice the last part is going to be a $100 debit.
It doesn't go back into cost of goods sold.
There are a number of different ways. The way your book is espousing as a convenient way is you just debit cost of goods sold, which increases. That's it.
Yes. So
That's how it works. That's how in fact these accounts that you saw.
So I do have a comment about that, given me finding loopholes and stuff like that
Fine.
in the history. So I believe it gives an unfair advantage to the companies to under-report,
Cost of goods sold 100.
So, right, and the reason being is that because when you're doing this estimate, you're doing it for this year's manufacturing and future year's manufacturing.
Right.
But so when it comes back understated or overstatement, that's a combination of all over. So now I'm taking the tax benefit today
Right.
from that part.
Right, I
not
agree.
counting it.
This, don't get me wrong,
Yeah.
this is okay.
Yeah.
So his point is you can possibly manipulate your income so that you can lower your taxes. Sure.
But
It's
I thought
possible.
these are internal accounts, not.
Well, no, well, ultimately,
Cost of goods sold.
this stuff
Right.
does overlap into the actual external financial accounting system, as you can see. So, so basically, we're sort of turning the dial a little bit to show you how manufacturers work. They keep track of their actual overhead and overhead estimated, applied is the word they use, separately. And at the end, they reconcile the two so that the actual is what is ultimately going to be represented in the books. Whether you like the fact that the difference, the plug I call it, is reducing cost of goods sold or increasing it, is an issue that we can talk about.
I thought I should have been reallocated for the,
Right.
proportionally by the time.
But the key thing I want you to get out of this chapter, and it's a recurring theme throughout this course, is how challenging it is in the real world to keep track of the overhead accounts, overhead costs, because they're indirect. If they were direct, it's easy. The fact that they're indirect forces firms to do various kinds of machinations, if you want to call them that, to keep track of things. This is one standard way that firms do it. They come up with a predetermined rate, basically allocate overhead during the period using this predetermined rate, and then they reconcile it with the actual overhead that they're also keeping track of, so at the end, they're basically adjusting cost of goods sold for the difference. That's very standard. It's like a budget because the estimate is really estimated, it's not actual.
Wait, so this is making cost of goods sold look like it was
In
more?
this case, it's higher.
Yeah.
Because remember, expenses are debited. If I credit an expense, that reduces the expense. If I debit the expense, it increases. So you can take out of this that when you have overhead underapplied, we're going to increase the expense. And when you have overhead overapplied, you're going to reduce the expense.
Yeah, but why is that bad, Artie? Because that's what you actually spent.
Oh, no, it's not bad at all. If it's all that you spend for production for this year. However, you could have continuous production for this year production and next year's production, and now you're taking the tax benefit for this year for stuff that you probably spent for future years.
Like you overbought for
Yeah,
future years.
exactly. You're
Now-
when you have like in our example in our books when you produce.
But then you're screwing yourself for the next.
Now, no, by the way, this book is not
Money
intended.
now is more of a better.
There's no journal entries in this book, but I thought, because I could tell there was some confusion, the question that I suspected you all wanted to know was how does this really work? So I am introducing a little bit of journal entries into the course. Okay. So, but at least you can hopefully get a sense that this is not being ignored, the actual, but this is the amount that goes into work in process. This is the amount that they keep track of as a temporary amount count. At the end, we do have to reconcile, and you can see how they do it. They zero out the stuff, okay? So that is pretty much all I wanted to say with chapter 14, okay? We're going to cover today, I know we have a problem, so let's work our way back now to case 3, I think it's 33, correct? 333?
You want to just.
The homework.
That was actually for the last chapter, we were sort of mixing and matching chapters, which is not necessarily a bad thing. It keeps us looking at the big picture. So do I have case 33 from who? Let's see, 1, 2.
I have to send you it.
Is this, Julie, is this case 333?
333, yeah.
Can you just, as a favor, it doesn't matter.
What
Now, another, here, thank you.
is it for?
That's from last week?
No, you gave this to me.
Yeah, we just gave it to you.
Oh, can you just write down the 333? I'm sure I'll figure it out, but
Sorry.
it's all right. Okay. And this is from chapter 2, thank you. Okay. All right, let's go through the problem, case 333. And let's do that now. I've got my... See, to the guys, today I'm prepared for any, if we run out of markers, I'm determined not to have that happen, so so we're all prepared. Okay.
And then the eraser.
I know, there's even an eraser, it's so nice. All right.
Yeah, that's fine.
Oh,
Cherry apple, it's great. Don't you guys need to make grapes smelling more?
Now, I want to make an announcement, guys. Chapter 6, we're going to cover today, and I do not need you, you do not have to hand in any homework for Chapter 6, unless you missed homework from the past. So for those of you who want to catch up the homework, only you guys, Chapter 6 homework, which deals with ABC costing, is for you only. So I'm going to make an announcement again. So Chapter 6, well, not for all of you. I'm skipping that for all of you except those who are trying to catch up with their homework. So it's,
If I did-
4 and 5 yet.
But we have 4.
And 5.
yeah, that's fine, but Chapter 6, is it, 5 is activity-based costing,
Oh, we don't have,
ABC.
we don't have any, oh,
4 is 425.
425,
So,
5.
so when we get to, today we're going to try, we'll see how far we go, but whenever we get to ABC, you do not, which is Chapter 6, none of you have to do it unless those who want to catch up can use that as an extra credit. So,
But does that count as our one freebie?
no,
Or we still have another freebie?
you still have another freebie.
Okay.
Oh, nice.
So I'm giving you guys,
I love free swag.
this semester's been a little bit chaotic, between the off Sundays, between me not getting in. This semester's not meant to happen, I think. It's just all this stuff happening. So we'll try to catch up in a reasonable way.
Wait, so you want our grades to be made up of 5 homeworks?
Yes, 5 homeworks. So basically, some of you are two homeworks behind. If you're 2 homeworks behind, you really only need to do 1 more. You're right. This semester you have 1 homework freebie. You don't have to do it. Therefore, I want, as I said, if you get rid of the Chapter 6, how many do we have left? 6. So at the end of the day, I need 5 homeworks from all of you. That's to make it clear. Okay, and Chapter 6 will count as one of them for those of you who want to catch up. Okay?
Yeah, that's not working.
Chapter 11. Yeah, but-
Chapter 1 was like a complete anecdote.
Okay. Let me discuss this problem with you before we do it. This problem relates to break-even analysis, which we spent time on in Chapter 3. By the way, Artie, is there water there? My throat is...
I will.
He's going down
Take care. I'll take care of you. Don't
Thank
worry.
you.
My
The drive was, I was like, kept calling Professor Geller. I'm lost. No idea where I am, which is
It's
true.
okay. We've all come to
No,
your class today and
I
taken
can't
your
tell you what that
time,
does to
so-
my nerves. I'm sorry. I don't. It's
We've
just.
all done it
Professor
to you.
Strauss texted us, we knew it was okay.
Thank you. I texted him to let you guys know. Okay.
We used our time with.
Good.
Oh, yeah, we use, yeah.
So Chapter 3 dealt with break-even analysis, which has to do with, let me erase this. Okay. Basically, we identified 2 equations in Chapter 3. This one is the broad equation, which can answer the following question. The question being, how many units do you have to sell in order to achieve a target profit that you have plus cover your fixed cost, okay? So in the real world, if you have this formula, you can you need to calculate this. You know what this is. This is your objective, i.e., we want to achieve $100,000 of profit this period. So you plug 100,000 in, you plug in your fixed costs, whatever those are, and you calculate this. This is equal to the selling price per unit minus all the variable costs that are related to the units. Those include direct materials, direct labor, variable manufacturing overhead, and any variable selling and administrative costs. Anything that varies with units produced and sold would be considered a variable cost for this purpose. So contribution margin per unit gives us the number of units necessary to hit this target profit. Now, if the target profit is 0, which is what we call, it becomes the break-even formula. Because break-even means you make no target profit. Your profit is 0. So this is a formula you should be aware of. Target profit, which will be equal 0 if you want to be break-even. Now this is the one, so this gives you an answer in terms of units. If you wanted the answer in terms of sales dollars, in other words, the question is, the CEO may come up to you, the manager accountant, and say, how much in sales do we need to have this period in order to achieve this target profit and cover our fixed costs? And so how do we alter this? Well, it's basically this equation, but instead of contribution margin per unit, we would substitute in here contribution margin ratio. So that would go in here if you wanted to end up if your answer was to be in sales dollars, okay? So we substitute this for this in the denominator. And that'll give you sales dollars, okay? Now the question is, what is the contribution margin ratio? Very intuitive number. It tells you, for every sales dollar you receive, how much of that is yours? What percentage of your sales dollar is actually kept by you, and what goes toward covering the variable expenses? So for example, if your selling price is $10 and your variable cost is 6 per unit, we know that's a $4 per unit contribution margin. $10 minus $6. How does that convert, though, to contribution margin ratio? You would take the contribution margin of 4 divided by 10, that's 40%. What is that telling you? It tells you that for every sales dollar, 40% is yours. The other 60% goes toward covering your variable cost. So that's that. If you put that into this formula, your answer will be in sales dollars. Now this formula is great if you have one product. But if you have multiple products, you have to make very strong assumptions about the sales mix. You have to assume that in order to use this formula, you basically you have the same sales mix and the same contribution margin ratio for all your products going forward. Nothing changes. So if you're selling 35% of product ABC and 65% of product XYZ, you're going to keep that sales mix indefinitely in order to use this formula for multiple products, okay? So that's the setting of this problem. This problem is asking how to apply these formulas to multiple products, okay? Strong assumptions. And so this is a great formula for one product company, but for multiple product companies, you have to make strong assumptions.
But didn't we just figure out if that changes, we do a weighted average? Did we do that problem?
The homework problem, which you did,
Yeah.
is looking at this issue.
Yeah.
So that's the setting of the problem you just did, okay? All right, so let's take a look. And I know Artie is doing me a favor. I hate to start.
This is the homework. We're going over that.
We're going to go over the
We did
homework.
it.
Okay, so I'll just go over and you can tell him what he
Yes.
you all right. So if you would, turn if you have your book, please. Let's look at this case 333, if you would. Thank you very much. Thanks. Case 333. Okay, so in this problem, they're basically looking at a company with more than one product. So this is the setting I told you that's a little challenging. You know how to apply these formulas to a setting like that. So the first question is, what is the company's overall break-even point in sales dollars? Okay, so in this case, we apply these formulas, but we apply them under the assumptions that I told you. That the sales mix stays the same, and that the contribution margin ratio also stays the same. So if you look at